What's up, everybody? Welcome to another episode of the Stock Bros podcast. My name is Tony. Thanks for joining. So this is going to be investing 101 type of video. This is very important. We're going to talk about how to invest with small amounts of money using an effective and proven strategy called dollar cost averaging. Now, this is a tried and true strategy, and it's one of two ways to invest in the stock market. So you can invest using a lump sum of money where you put a large chunk of money in at once, or you can invest through dollar cost averaging, DCA, dollar cost averaging. So let's start with lump sum first, okay? Now, a lump sum is when, let's say you want to put $1,000 into a particular stock, ETF, mutual fund, whatever. And what are the pros? What are the cons of this? Well, the pros are you could have a much greater return in a faster rate than if you were to do dollar cost averaging if you time the market perfect and you hit it at its absolute low and the market takes off. And that's all great, and most of the time that doesn't work that way, and it's very, very hard to invest using this strategy. Now, the other way, and the cons of this is you could invest that $1,000 at the worst possible time when you think the stock market or a particular stock or the market in general has hit its low, and really it hasn't hit its low, and we go on a 3-month bear market, and now you're just in a free fall for 3 months, and it's going to take 3 months of incredible growth to get back to zero and square one. So that's the first way. The second way is dollar cost averaging. Now, this way is very effective if you don't have a large sum of money laying around to just throw into the stock market. Now, dollar cost averaging is a tool you can use to build wealth over time with small amounts of money. This is exactly how your 401ks work, and this is exactly how your retirement plans work if you have them through an employer. Obviously, you're not throwing hundreds or thousands of dollars a week out of your check into a retirement plan or 401k. You have a percentage of your check, unless you have a huge salary. Maybe you are if you have a huge salary, but you take 3 to 6% usually of your income and you invest it every week, the same amount, into a mutual fund or an ETF, and over time it builds and builds and builds with compounding interest. Now, I know a lot of you say, well, if you're dollar cost averaging and the stock market goes up, the stock market always goes up, right? And you're dollar cost averaging and you're putting money into a fund every week. Well, isn't that just going to raise your position and you're going to keep buying at a higher price? Yes and no. Because the stock market doesn't always go up, and if anybody out there can find a stock that does nothing but goes up every week, please let me know, because I want to put every dollar I have into this stock and invest into this immediately. No stock goes up every single week. There's ups and downs, and sometimes you're going to be buying a company at its high point, sometimes you're going to be buying it at its low point, and it's going to average out. And this is how you build wealth over time. And by doing this, you're also protecting yourself from market volatility. You're preventing yourself from buying in to a company at a bad time, and when you think it's at its low, but it's not. And, it's a great example of how compounding interest works and how dollar cost averaging works is you can download a simple investment calculator, and you can use something like Smart Asset or Bankrate.com. They have some great ones. And what I did was I pulled up a simple investment calculator through smartasset.com. And in this example, to show you how dollar cost averaging works and how effective it is, we're going to use the S&P 500. We're going to use ETF VOO. This is Vanguard's fund for tracking the top 500 companies in the U.S. Why are we using this? Because the S&P 500 index, which tracks the top 500 companies in the United States, has an average annual return of 9% per year for like 70 years now. So this is like tried and true investing. This is what most mutual fund managers are putting your money into anyways. So in this example, VOO is $350 right now. We're going to start out with one share and we're going to add $50 a week into VOO for 20 years. What this is going to do over 20 years, you're going to invest $52,000 of your own money, and you are going to have a return of $168,000. Investing $52,000 in 20 years, you are going to have a total return of $168,000. So what does that mean? You just made $115,000 dollar cost averaging for 20 years with a very small amount of money, with only $50 a week. And obviously it doesn't have to be $50 a week. You can use less, but the more you can put in, the higher your return is going to be hypothetically. Now, this is all hypotheticals. This is assuming the market is going to continue going up. This is assuming we're not going to have any remake of the 1929 stock market crash. But in theory, because the market is always going up, sometimes the market goes down, but it's always trending up over time. In theory, you would have a really nice return in 20 years, dollar cost averaging with a small amount of money. Now you can go and figure out how much you would have on your own. Go download a simple investment calculator online. You can use Bankrate, you can use smartasset.com, and you can figure out how much you want to put in a week and what your hypothetical return would be over a period of time. Now, some of you are saying, well, VOO is $350. How can I dollar cost average into that? I can't buy a share at $350 every week. Well, this is where you're going to use fractional shares. I shouldn't say most, but there's a lot of brokerages now that give you an option to buy stocks and ETFs using fractional shares. So you can buy a portion of the share. You can buy as little as $1. I use Fidelity and I use Public, an app called Public, to do this. Now, luckily, Fidelity has fractional shares on ETFs and all stocks. Some brokerages like TD Ameritrade, Webull, Charles Schwab, Vanguard, they don't allow fractional share purchasing yet. I assume at some point in the future, everyone's going to have it. But if your brokerage doesn't have fractional shares, you can download my link for Public below, and you can buy ETFs like VOO, and you can dollar cost average every week. And I'll put my link in the video description. And also you can use something called Acorns, and I have a link for that as well. Acorns rounds up your spare change purchases. You link your card and then invest in ETFs like VOO, and you can invest for as little as $5, as little, as in small micro investing amounts of money. You don't need a whole bunch of money to start investing. You can do it with very small amounts of money. Everybody can invest in the stock market. Doesn't take a lot of money. Dollar cost averaging. So I hope this helped. If there's anything you didn't understand or something you feel I didn't explain well enough, just leave a comment and I'll get back to you as soon as I can. I try to be really good about responding to comments in a quick and timely manner. But thanks for watching. Please subscribe. Please like the video. And just let me know what you think. All right. Thanks for joining in.